Welcome to the Novari Capital Markets Insight. It's August 14th, 2023. I'm Todd Patton, Senior Vice President. This is James Harlow, Senior Member of the Novari Capital Investment Team. And we're going to go ahead and get started. James, since last time we spoke, it was in May, and at that time, markets had a great start to the year and it's continued. How are things really trending since then?
Sure, I'd say there's continued to be positive momentum in the equity markets. S&P 500 and NASDAQ indexes both with strong double-digit gains so far this year. Dow Jones up in kind of the high single-digit range. In terms of the factors that we talked about back in May, continue to see some good progress on a lot of those. Particular inflation. Back in June 2022, inflation was over 9%. Most recent reading that we've seen here is a little bit over 3%. So there's been a lot of progress there. Not where the Fed wants us to be. The Fed wants to get us more towards 2%, but I say that progress has been, definitely a positive for consumers, for corporations, and just for the equity markets in general. In terms of economic growth, continue to see resiliency there. U.S. GDP growth is, for the first 2 quarters of this year, been kind of in the 2 to 2.5% range, and for the full year, expected to be about 2%, maybe a little bit higher. So that would be more kind of in line with the historical average we've seen over time, and definitely contrary to the calls for a recession that we saw coming into this year. So I'd say that that's been definitely a positive, and I'd say a driver of that better economic activity really has been the consumer. The consumer is about 70% of the U.S. economy, and the jobs market continues to be quite strong. Unemployment rate is near historic lows. Wage growth has been quite strong as well. So I think that's been a nice underpinning for the economy. In terms of corporate earnings, not too much change from when we talked back in May. Still looking for kind of a flattish year there. We're still in a process of kind of a normalization of supply and demand and also profit margins, but there's an expectation that in the back half of this year and into 2024 that we're going to see a bounce back in earnings. In terms of the Fed, if you look back to last year, they were on pace raising interest rates by kind of 75 basis points per meeting. They've since downshifted to 25 basis points. There's been a slowdown in the cadence there, and in fact, back in the June meeting, they didn't raise rates at all. So I think with as we talked about before, the progress on inflation, I think that it's possible we might have seen the last Fed rate hike, and there's possibility as we get into next year that they will have the opportunity to cut rates. So basically, I'd say just in terms of, in hindsight, coming into this year, I think just, investor sentiment was maybe overly pessimistic, especially around economic growth and around earnings. And I think that for certain, the data has come in better than expected. I'd say one, catalyst that we didn't talk about back in May, but we're talking about a lot more now is definitely artificial intelligence, or AI. There's been a lot of excitement about the ramifications that could have for society, for the economy, for just growth opportunities for a lot of companies across a lot of different sectors. I think it'll be quite some time before we, really see, all the full impacts of that. But in the meantime, it's had the impact of, really driving up the share prices of a lot of companies that are large portions of the big indexes like the S&P 500 and the NASDAQ. So that's also provided another uplift for the markets as well.
Yeah, so those are some great positive catalysts, and the returns of the indexes have been really strong this year. Interestingly, as I speak with clients, some clients don't realize the market is up as much as it has been this year, and they're not really feeling real positive about things. Why do you think that is?
I say that that's a good question. I mean, I think that last year was a frustrating year for investors. I think with both stocks and bonds being down quite a bit, I think some of that pessimism from last year, carried over into this year. And also, I think that just as a reminder, I mean, the U.S. equity markets are still not back to the highs that they reached in early 2022. So I think investors are aware of that as well, and that's kind of in the back of their minds. I'd also say, just from a day-to-day standpoint, that there's a lot of aspects that all of us are still grappling with in terms of higher prices at the grocery store, at restaurants, just elsewhere in the economy. And I think higher interest rates in terms, auto loans, mortgages, credit card debt. So I think that that's still, sort of a nag that all of us are dealing with. And I think just, geopolitically, still a lot of that, a lot of these stories with Russia, Ukraine is still a major issue. U.S.-China relations are just, we keep seeing it on the nightly news, and I think it's kind of at the, forefront of our minds. So I'd say that those are all elements that would, make it more difficult for investors to, fully appreciate the bounce back we've had so far this year.
Yeah. So what are the major risks that we're monitoring for our clients?
Sure. I'd say that, logic would tell you that, the Federal Reserve raising interest rates from near 0% to over 5% would have negative impacts on the economy. So there is a possibility that as the months go on that we'll see some erosion in the economy. And I would say that the likely catalyst would be if, something happening with the consumer. And that could be that, excess savings that consumers have accumulated since COVID. If that gets exhausted, that would be one potential catalyst. The jobs market cooling, and getting weaker, I think would be also a potential, thing to look out for. I'd say we're also keeping an eye on bank lending standards, which have been tightening recently, and if that were to, extend for a longer period of time, would definitely, I'd say, would weigh on the economy. I think in terms of another risk would be just the Fed higher for longer scenario where, we talked about how inflation's gotten down to 3%. They want it to get to 2%. And it's possible that that last mile down to 2% inflation is just going to take longer than expected. We've had a lot of cost normalization that's happened over the past year, but it's possible that some of that has been low-hanging fruit, and that there's more difficult prices to try to get down, and especially in terms of shelter and food and some other aspects. So I think that that's just a possibility that the Fed has to keep rates higher for longer. Not only would that increase the risks of a recession, but it would also be contrary to kind of current investor expectations that the Fed is going to cut early next year, kind of middle of next year. So I think that would potentially cause a sell-off. I think lastly, just valuations are a bit elevated versus history. I mean, the S&P 500 is trading near 20 times earnings, and historically it's been more towards 16%. So just a little bit more elevated there.
Yeah. So you started off, you gave us some nice tailwinds or positives, then you've identified some risks. What's your thoughts on the rest of the year?
Sure, I'd say that with the strong gains so far this year, I mean, I think it would be challenging to repeat that in the second half. But I would say in terms of the near term, and what I mean by that is kind of the next couple of months. I mean, I do think we might have just a little bit of sideways action here in the markets. I think investors may take a pause here just to kind of wait and see on how inflation data comes in, economic data, earnings, what the Federal Reserve stance, and just kind of see how things go before kind of seeing how they want to position. I would say that in terms of the longer term kind of period, an environment where you get resilient economic growth, earnings growth, inflation continuing to moderate, Federal Reserve being able to sort of pause and then start to cut rates. I mean, I think that's an environment where the equity returns could be quite solid. Again, looking over more kind of a longer term period. One other aspect to mention is just I would say investor sentiment is not bullish or particularly exuberant right now. In terms of looking at sort of cash on the sidelines, there's about $5.5 trillion of investor funds that are in money market funds, which that's cash that can be deployed once investors start to feel better about kind of market prospects, and that money coming in the market would just drive up demand for equities, and would increase potential returns there.
Yeah, great. So another question that I want to run by you, I'm hearing from clients is, we hit some market highs back in 2022, then the market went down, and now clients are getting back up to where their high water mark are or close to it. So clients are asking, any change of strategy, or what should I do? You got any thoughts about that?
Sure. I say that we continue to advise clients to focus on the long term. There's going to be both for the market and for the economy ups and down cycles. I think that's perfectly normal. I think if you think about the longer term, the S&P 500 average annual return, total return since 1950 is 11%. But the best way for a client to have achieved that return would have been to have stayed fully invested and not try to time the markets. I'd also say that bond yields are a lot more attractive than they've been over the past few years. I mean, if you look back, a few years, it was 2 to 3%. Now we're looking at 5 to 6% opportunity there. So I think the combination of the equity markets bouncing back and bond yields being higher, I think it's a great opportunity for clients to sit down with their relationship manager and really review their asset allocation and their risk tolerance.
Good. Well, those are some great thoughts. We appreciate your time today, and thank you guys for watching.